Oh, hey there! So today I'm going to be explaining tax-free savings accounts, or otherwise known as TFSAs. So you may have heard about TFSAs before, whether it's from your family or friends, or maybe it was the last time you walked into a bank, the teller asked if you wanted to set one up. But you weren't quite sure what it was and what the benefits of a TFSA were, so you walked away. Well, I'm here to tell you that TFSAs really are quite simple. There's nothing complicated about them. All they are is a registered investment account that you create at a financial institution. So you could walk into your local bank, you could go into your credit union and open a registered account. That's a TFSA with them. And within this registered account, you can hold a portfolio of different types of investments. So these could be shares of a public corporation, they could be bonds, they could be mutual funds, they could be real estate investment trusts, stock options, and that's just to name a few. There are many more that are eligible. Basically, any investment that would be eligible to be held in a RRSP is also eligible to be held in a TFSA. So you may be thinking, okay, that's all well and good, but why would I actually set up a TFSA? Why wouldn't I just, purchase stocks and bonds in my normal non-registered account? What's so special about a TFSA? Well, just as the name implies, a TFSA, the income earned within the account is tax-free. And what that means is, for example, you're holding a portfolio, it could be stocks, it could be bonds, and these pay dividends, they could pay interest, you could be buying and selling, the stocks, which means they would trigger capital gains. So normally in a non-registered account, these would all be subject to tax. They would need to be reported on your tax return. But within a TFSA, all the income, either through interest, through dividends, distributions, capital gains, they're all tax exempt and sheltered. So to demonstrate how incredibly powerful of a tool the TFSA is, let's use an example. So let's say you had a lump sum amount of $50,000 and you wanted to buy an investment, it paid 8% per year, and you had a marginal tax rate on your investment income of 30%. Now you could either choose this to be included in your TFSA or to be in your non-registered account. Under TFSA, your year one interest income would be $4,000. That's the $50,000 lump sum times 8%. And all of that $4,000 would end up back in your pocket to be reinvested for year two. So you could fully leverage the power of compound interest. However, under the non-registered account scenario, that $4,000 of income you would generate would be subject to the 30% tax. And so you're left over with only 70%, which is $2,800. So in year two, you only have $2,800 to reinvest back into purchasing more investments. Now, if we were to expand this example out over 5 years, at the end of year 5, in your TFSA, you would have a portfolio of around $73,000. And in your non-registered account, it would be worth $65,000. That's a difference of $8,000, just simply putting that $50,000 lump sum into your TFSA rather than a normal non-registered account. So now that we've learned about the power of using a TFSA for your investing purposes, there's a couple things I like to point out. First of all, for a TFSA, any contributions that you make is not deductible for tax purposes. So this is an area that is not like an RRSP, whereas in an RRSP, any contributions you make are deductible for tax purposes. For TFSA, they are not. But however, on the flip side, any withdrawals that you make from a TFSA are also not taxable either, whereas for an RRSP, they are taxable. You'll also need to be aware of the contribution limits that are in place and ensure that you don't exceed them. So if you do exceed them, CRA does charge quite a hefty penalty at 1% of the excess balance per month. If you haven't made any contributions to date, the maximum contribution room that you have as of 2020 is $69,500. And each year you will get access to new contribution room. That's usually determined based on what government is in power, and what their budgets look like. If you don't contribute to your TFSA and don't use up your contribution room for any given year, it'll just be rolled forward to the next year. And now your next year will have a higher contribution limit. In terms of withdrawals, any withdrawals that you make in a year, you will get the same amount of contribution room to the amount that you withdrew in the following year. So for example, if you withdrew $10,000 this year from your TFSA, you'll have access to an additional $10,000 of contribution limit starting the following year on January the 1st. So just keep that in mind. You can't just withdraw the money this year and then recontribute back this year if you're close to the contribution limit. And that pretty much sums it up for TFSAs. Pretty simple, right? If you guys found this video to be informative and liked it, please hit the thumbs up. If you guys want to see more personal finance videos from me in the future, please consider hitting the subscribe button. And if you guys have a question, please leave me a comment and I'll try to respond. And I'll catch you all in the next one.